Hey everybody, welcome back to the today's Market Explained, a FourStar media event. Here we are in our podcast and video series. I'm Brian Castle, and I'm your host. And I'm along with me is Chris Reardon. Chris, welcome to the podcast.
Thanks, Brian. Good afternoon, everyone, and glad to be here and talk a little bit about the markets.
Well, great. Well, everybody, Chris is our FourStar development director, master of all things portfolio. He's a Cleveland native, and he's got a young family of three. And welcome, my co-host.
Thanks, Brian.
And I'm Brian Castle, your host. As I said, I'm the founder and CEO of FourStar. I'm an Eagle Scout, a trustee of the National Boy Scout Foundation, philanthropic advisor to clients and advisor to CEOs and insiders, chief dad to Quinn and Evan, and husband to the amazing Trippy. Thanks, everybody, for joining us. If you like what you're hearing today, please let us know and give us a 5 out of 5 ranking on the Apple iTunes system, which is where you can do rankings. That would be very good. That helps our numbers and helps our reach. We are ranked in the top 1% of podcasts in America. We want to stay that way and grow. So today we're going to talk a lot about the markets and the economy. A lot of very strange things going on right now, right, Chris?
So, yeah.
Why don't we get right to it? Let's talk about the markets. We're having a big market meltdown in the last couple of days. But what are the relationships still between the different asset classes, Chris?
Yep. Yeah. And I mean, I think it's important to point out I know the markets today, which is August 2nd, are having a big down day. These aren't taking that into consideration yet. So, be wary. Probably the next podcast, these might be adjusted more significantly. But domestic equities since the last podcast actually gained 7 points. So it firmed up to 321. So it's back in the 320s. Which it kind of moved out of from since the beginning of the year, more into the three in the teens, kind of between 310 and 320. So that moved back upwards.
Right.
International equities moved back 6 points to 249, and commodities pulled back 6 points to 249. So both are still tied. They moved back in sync, the exact same, and still hold that number 2 position and tied for it. Cash, interestingly enough, gained 2 points. It's at 120 now, in 4th position. Currencies gained 2 points at 81 points now in 5th. And fixed income, it was flat at 69 points overall. So, I think one of the trends, and this isn't what we've seen so far, but one thing we'll keep an eye on is that cash positioning. We really haven't seen that move gain points. Really, if it has, it's been maybe at 1 point or the other, but small this year. So we really haven't seen that a significant move upwards in cash. So if we see that start to gain momentum, that could be a sign of a lot more volatility coming to the market. So it's something to keep an eye on. We haven't really seen that yet so far, though.
Yeah, most of the downticks in commodities international went to domestic equities. Although, as you said, Chris, some of these numbers will get adjusted now after these 2 very, very difficult days in the market. So we'll see what it looks like when we're done. But very confidently in our last episode, I said we are in a bull market, and of course, bull markets continue until they don't. Mm-hmm. And right now, it's not. So, but we'll see if it's just kind of a short-term couple bad days. We'll explain why those bad days are happening. And then commodities and international still tugging it out for the 2nd position, and we'll see which one emerges. And then a little bit of movement hit the cash and currencies, like you said, but not much. We'll see. But Chris, the first one that kicked it off in the earnings season was Microsoft, right? And that was down. The earnings were lighter than expected. Stock was down 7%. And the previous day, NVIDIA, which is the AI chip maker, they began a downtrend, being down 7%. That's rallied a little bit, but now everything's down big in the last 2 days. So, Chris, what do you have on the market?
Yeah. I mean, I think, what's been this week, and I think this has really been a spotlight on it, has been the Magnificent Seven and tech in general. And will their earnings hold up? Will these mega caps earnings hold up? And there's been some that have done better. Apple certainly had better earnings. So there's been a handful. AMD was another one that had better earnings, but there has been some heavy misses. Most notably today, one of the big drivers was Intel. So Intel reported earnings today, and they actually came out and said that they were going to cut 15,000 jobs over the next year, and that they were going to halt their dividend payments. And this is they're trying to kind of shore up and drive cost savings and boost their bottom line. So, that's always been kind of the narrative of, are the earnings going to keep up? We're at these. It's a bull market. We're at these really sky high valuations, especially when you look at Nvidia and some of these. Are the earnings there to justify that? And it wasn't always going to go up, and it's never is always going to go up, but we're definitely seeing a big spout of volatility as the Q2 earnings seem to have slowed. If you guys recall from some of our earlier podcasts, Q1 earnings, really on the face of it, were pretty good. Overall, those actually held up. So Q2 earnings seem to be a little bit more mixed.
Yes. Yes. And now we're seeing a lot of selling of tech stocks now. Of course, we were hitting new highs, and valuations weren't wildly out of control, like for example, 1999, but they were getting up there. And now we're starting to see those tech stocks sell off. We have seen, a really, really strong uptrend without much of a downtrend since November 1st of last year. We haven't seen any 5% down move at all. So we're going to see that now. In fact, the last 2 days alone is about 5%. Most of the benchmarks are down 2% or more. The Russell 2000 small caps were up 11% over a period of only about 3 weeks. We're giving back about 4% of that today as well. So not a surprise. But, the other thing that's going on is there was a lot of speculation in currency, and the carry trade, Chris, is unwinding, right? Tell us a little bit.
Yeah, and we briefly talked about this, I would say probably 3 or 4 podcasts ago, but there's been this big yen carry trade. And for those of you that don't, for terminology wise, the carry trade really just refers to borrowing or in some cases shorting a cheap currency, in this case the yen, and investing that in a stronger or higher yielding currency. So the yen has been notoriously weak, and this year it's been the weakest it's been in decades, as trading as low as 163 yen per dollar. But earlier this week on Wednesday, the Bank of Japan came out and said that they were going to raise interest rates from neutral to 0.25. So from flat to 0.25, which in many cases actually went against the grain. There they have slowing spending. They have a lot of issues going on, and inflation necessarily isn't one of them. So it kind of came, I think, as a little bit of a shock that they did that. But mostly that was probably to defend its currency. As interest rates are higher, the currency tends to perform. You can get better yield out of that currency, things like that. So what you're seeing now is the reverse of that, the reverse carry trade. So you have people that are short or borrowed yen. Now they have to go and buy that back. So we're seeing that pressure on the downward dollar, as well as the investments that they put them in, whether it be bonds, treasuries, things like that. So this unwinding of this reverse carry trade is definitely playing out through the global market right now. And I think that's not the entire factor, but that is definitely contributing to the higher volatility we're seeing. And to give you a little bit of kind of framework around that, the VIX, which is obviously the volatility index, has more than doubled since early July. July was, kind of in this framework around 12, 14. Now it's trading at as high as 30 today, or it's close to touching 30. So you can see where it's really spiked up recently.
Yes. The volatility is up, markets are down. We're seeing huge layoffs. Intel had huge layoffs. Let's talk about the economy, though. What are the numbers in the economy, Chris, that are happening? There's a weaker jobs report and recession fears, which is what the Fed was trying to do by keeping interest rates high. So now we're finally getting that. Looks like recession territory. But what numbers do you have, Chris?
Yeah, and I think it's, the big number that's driving the movement today in the markets, a big pullback, is the non-farm payroll numbers that came in at 114,000. This is for July. That was well below the expectations of 185,000, and was down from the revised down figure, I should say, of June of 179,000. So, what that really does is, I think what the market's doing at least is it's in the market's opinion cements in a September rate cut. But usually we would see a pop off of that, right? Their rates are going to come down. That's going to, loosen up more money and things are going to flow. The economy is going to start up again, if you will. But the reason I think we're seeing this big pullback right now is because now there's fears that this rate cut is going to be too late. If non-farm payrolls are 114 and all these other non-farm payroll figures are being revised down, what's really the state of the job market, and are things really worse off than the Fed has sees it? And by the time they start, cutting rates, are we going to be deep into a recession? That's the fear, and I think that's why we're seeing such a drastic pullback. And I would also say that I think this pullback is because if you go back 2 or 3 weeks, as you said, Brian, we had a huge run up, especially in small caps, to this out of the expectation that, this September was going to come. They were going to cut rates. That should help small caps. But you were going to see kind of this Goldilocks theory. Essentially, the market was baking in a Goldilocks moment where the Fed was going to cut at the exact right time. Things were going to be perfect. We were going to avoid a recession. And I think this pullback is really the market coming to a realization that, is that going to happen? We don't know, but the likelihood of it isn't as possible as the market was kind of baking in. Outside of that, a couple more numbers. The July year-over-year wages increased 3.6%. That was actually the smallest wage gain year-over-year since May 2021. So we continue to see wages come down a little bit. Unemployment rate rose to 4.1% in June, and that's the 4th straight monthly increase in unemployment. So once again, a lot of these figures show to a weakening job market. And if any of our listeners have, even read or listened to some reviews of what the Fed says, what they always have been pointing to is the job market remains strong, consumer spending, and with all these, it really shows a deterioration in that job market. So average hourly earnings rose 0.2% last month, and so that's still a slight decrease. It's a 0.1 decrease from the June to July numbers. On the, I guess you would call positive front, the US PCE, personal consumption expenditures, rose 2.5% in June year over year. And this is the inflation indicator that the Federal Reserve likes to use. That slowed slightly from a 2.6% increase pace in May. And then the core PCE was up 2.6%, which was even the same as it was in May. So, they use that as a proxy for the most part for inflation. So in their mind, inflation's still above where they want, which is 2%. They've stated that, but it is getting closer. Whether that's true or not, or what's impacting that, remains to be seen, but that is what they're keeping an eye on. And then the US GDP numbers came in. They rose at an annual rate of 2.8% in Q2. That was well above expectations at 2.1%. With the major contributors to that GDP number being consumer spending on goods. That was up almost 1% from Q1 to Q2, a little over 1%. The federal government spending bumped up another quarter of a point, or 0.25%. And then change in private inventories was up 1.22% from Q1 to Q2. So, I think the concerning aspect of that is some of these change in private inventories is, buying the raw materials to, purchase goods. You have those inventories. On consumer spending, both of those were the big contributors to that bigger than expected Q2 GDP number. And with a weakening jobs number, weakening consumer spending overall, those look to probably have a pullback in Q3 if this trend continues. So we could see a much weaker than expected Q3, I think, is the fear.
Yes. Well, a lot of interesting numbers, all pointing to the market, to the economy slowing down, basically, right?
Yeah. I mean, I think everything we saw besides, and once again, this goes back to Q2, so it's not even the most recent. Besides that Q2 GDP number, everything else has been pretty much negative, which, as we've talked about, it's almost like negative's good in the fact that most likely that'll push the Fed to lower rates quicker, most likely in September. And I know the markets now is saying I've seen as high as like 4 rate cuts, really almost a rate cut every month, kind of at the back end. I don't know if that's realistic or not. I think that is probably a little too aggressive, but we'll see. I mean, if things do get very, very volatile, I would say, and we saw this most recently, I would say in 2018. If for some of our listeners, if they remember, we had a huge pullback in 2018 and coming into Q4, and that really that volatility, we had some mini rallies there, but that lasted almost the entirety of that fourth quarter, and it didn't relinquish till I believe it was Christmas Eve or the day after Christmas, when the Fed finally relinquished and really started aggressively lowering rates. So, it's just going to be interesting. I think what we can really say is volatility is going to be most likely here more frequently for the rest of the year, probably.
Yes, and the markets go on for long periods of time with low volatility, slowly rising. That's the normal condition. About 85% of the time. And then about 15% of the time, we're in this kind of mode where we're in correction. Yep. Outright panic in some markets. We've been through those. So far, we're just having a couple of really sharp down days right off the highs, right? So this is not any kind of a market that would move any of our indicators to be negative, but another week of this would for sure,
Right.
So we're going to take a little bit of protection very soon if we need to. But right now, we're still staying fully invested. We're just having a little pullback, and that's nothing to react to. So, okay. Well, good. Well, Chris, in addition to the things you mentioned, the U.S.-European trade balance is a big deficit, largest deficit since the 2000s, more than the 2022 deficit. So that's not a good thing. The CPI came in at 3% year over year in June, which is the lowest rate since June of 2023. And you talked about jobs, and the U.S. Added 206,000 jobs in June, but now those are all being revised downward, aren't they? Right.
Correct. Yeah, it was revised. So that June number was revised down to 179,000. So it was down. I mean, that's pretty significant. Pretty significant.
Right. And then unemployment claims are rising. The week of July 13th increased 20,000 to 243. And then the next week after that, you said was 249, Chris, I believe.
Correct. Yeah. So it was rising slightly.
Yeah. So very, obviously that's the stuff that happens when recessions begin. Single family housing starts fell 2.2%. Now that's partly because of rates. The housing market's really slowed down. And we're starting to see housing prices drop. But single family building permits also dropped. So interest rates are causing the building and the real estate industry to slow down. But also, just the general economy is causing that as well. And China, on the other hand, the consumer price index rose in China, but it was below expectations. So China is actually showing recession. Their producer price index fell as well, the 21st straight month in China. Europe kept their interest rates unchanged in July, but then this month they did lower, didn't they?
Yeah, this month they did lower. Correct. Yeah, they made kind of that first. They were one of the first ones that did kind of take that first endeavor to lowering rates. And then the Bank of England, I will mention just this week, they cut their interest rate by a quarter point, now down to 5%.
Right. Okay. All right. And then oil prices have felt steady, but now they're starting to drift a little bit as well, Chris, right?
Yeah. So oil prices have been mostly steady, although this week, at least so far, they're headed for their fourth successive weekly decline. Most of that's been fears that we're kind of entering a global period of slowdown, potentially recession. We did see a bit of a spike midweek this week with Israel killed two of the leaders of the Iran-aligned militant groups, Hamas and Hezbollah. So that, whenever you have that tension in the Middle East, and that still certainly is there. It's just right now it seems like the narrative of slowing global demand is outweighing the tension in the Middle East, but it's something to keep an eye on. If you went to the gas station midweek, you probably saw a spike in gas prices, mostly due to the pop midweek. And I would say on the top of that, gold is at set for its most significant gain in 4 months. It's up 3.2% this week. Most of that is once again baking in faster rate declines or rate pullbacks from the Fed. But on top of that, you're also just seeing gold usually spikes when we see this volatility in geopolitics and the world. You have Iran now, which, from reports could have a nuclear weapon as soon as like next year or already have one. So when you have that global instability and concerns, you see gold really start to thrive. So gold certainly had a nice run up so far this year.
Yes. So okay, so a lot of interesting things happening there. On other fronts, we're seeing a slowdown obviously in the economy. There's some unique, interesting things happening. We could see cocoa prices increase dramatically. Country of Ghana, that produces much of the cocoa in the world, they were saying that the infected swollen shoot disease is affecting their crop. They said 25.7% of their crop was infected. Now they're saying 81% of the crop was infected. So if you're a chocolate lover, just get ready for some higher prices there. Ghana and the Ivory Coast produce about 60% of the world's cocoa. So cocoa prices were as high as 175% up year to date. They've come down a little bit in the past few months, but it looks like it might go back up and get worse. So watch out, all you chocolate lovers. And then also on the commodity front, copper is getting hit as China continues to stagnate and their market's beginning to think that there won't be any stimulus. So copper was down a number of days big. And so some of the industrial metals are getting hit, and that's also a sign of recession. So then the question, of course, is how bad does a recession get? Do we have a really bad recession or a mild recession? Because this market was rising, nearing new highs, and everyone aware that a recession was coming. So now the reality of the recession is happening. Market's getting hit on the recession fears, but then is the market already kind of discounting the fact that the recession is going to be mild and they're looking 6 to 12 months out? And that could be what was happening when the market's hitting new highs, and then just the realization of it, you have a little correction, and then maybe we'll go back up. So we'll see if that's the case. But Chris, if the recession gets much worse, then obviously the markets will probably get much worse instead of just a little bit of a couple day correction like we're having right now.
Yeah, no, exactly. I mean, I think right now, the correction we're seeing right now, I think is just we're seeing a heightened increase of the potential for there maybe being a worse recession or a worser than expected recession. You could still see the Fed thread the needle. There's a lot of scenarios that play out. I think right now is more just kind of a repricing as some of the economic data that came out as far as the odds of certain things happening, things like that. What traders are making bets really out there.
Well, and then the latest trader bet is that there's going to be at least 100-point move downward in interest rates. So the Fed funds rate will go down 1 full percentage point by the end of the year. That's what the market is saying right now, discounting the market. So that could be in September, it could be in November, it could be in December at the different Fed meetings. We'll see. But the reason the Fed raised interest rates wasn't really necessarily just to recess the economy. It was to ward off inflation and to kind of poke a hole in the inflation problem. And that still hasn't been solved. So then the Fed is in a little bit of a box because inflation is stubbornly at 3% or higher. Their target is 2%, and they said they won't lower rates until we get to 2%. But now at the recent Fed meeting this past week, the chairman said, well, look for possible rate declines, but are they going to break their own guidelines and lower interest rates when inflation is high? Because what that could do is inflation could turn around and go back up. And everyone knows now that the inflation calculation now has changed. So a 3% number now is probably close to a 7 or 8% number from the 1970s. And when inflation got up to high double digits, 17, 18%. And so, back when we were 9% in June of 2022, that was the equivalent of about 17 or 18%. So it got as bad as it did in the 70s, but just for a short period of time. But it's still stubbornly high. So if the Fed lowers rates, they risk inflation going up again. And that's exactly, frankly, what happened in the late 70s. In 1979, inflation was pretty much down. And then all of a sudden they started easing. government spending, lowering rates, and boom, inflation took off again. And then we had almost 3 years, a change of administration. Ronald Reagan came in 1980, and then it took almost 3 years to get the economy back to a growth phase because inflation came roaring back. So that's the risk here. The Fed is kind of dancing. Did we lower rates? Did we not lower rates? We said we wouldn't lower until things got down to 2% on inflation. We're still not there. Are we going to see that by September? I don't know. Consumer spending has still been okay. And then there's plenty of government spending, and that's really, running $2 trillion deficits every year, and that's causing a lot of spending as well. So if the government spending, Chris, that might be a way to ward off inflation too.
No, I mean, 100%. I mean, I think if you think of inflation, it's a supply and demand issue, right? So really the last couple of years we've had over demand. We've had, so much money pumped in to the market, to the economy. There's been so much money going around that people can just kind of throw money wherever they want. You have all these people wanting to take trips everywhere, all this. So there's this demand. Supply can't keep up. We're seeing prices just rise. To really get that under control, I mean, as harsh as it sounds, the Fed needs to cause a little bit of pain. You need to pull back that demand and have people not spending as much because until grocery stores, until aircraft or air carriers, all of them, until they see that demand pull back, they're not going to lower prices. I mean, that's just they're leaving money on the table.
Now, we are starting to see some travel outlets offer deals for the fall, thinking that there's going to be a rough recession. So some of the resorts and some of the airlines are doing like ticket packages. So they're seeing a little bit of that, or they're anticipating it. So they want to make sure they book in and get the money now and that kind of thing. So we're seeing a little bit of that. But yeah, I mean, so the bottom line, everybody, long discussion about all this and all the details is that the economy is pulling back. We're going into a recession. Question is, how bad does it get? And if it gets really bad, then how bad does it affect the markets and everything else? Or is this just kind of a mild recession and then we go back upward and then the Fed lowers rates and everybody's happy, right? The economy recovers. So we'll see, and we'll watch. We'll be here to tell you what we see and what's happening and why. Today's big market decline is on all the tech issues and all the earnings misses, and of course that carry trade from the Japanese yen that's unwinding now as well. So we'll see where it goes, Chris.
Yeah, no, I mean, 100%. I mean, I think it's definitely been obviously the volatility based off of economic drips as they've come out and things like that. So we can't really predict the future. We'll just got to kind of take the weeks as what they give us and take it month by month, week by week.
Yes. So so moving to what we see out there, kind of general review. There's a lot of interesting things happening. The Rolex market is exploding, and inventories are starting to rise now. But for a while, there was a really, really tight market for Rolex. And so, if you wanted to get your loved one a Rolex or a gift, prices were rising dramatically. So that's kind of an interesting thing. We also have continuing discussions about commercial real estate. So after the pandemic, when everyone went home and didn't go into the office to work, a lot of people got used to that. So a lot of people are working home. Oh, that trend is changing and people are coming back to downtowns. Chicago's downtown is getting pretty full now. But our building particularly has still got a lot of vacancy because it was a building that had a lot of attorneys who now stayed home. But commercial real estate is a huge opportunity. It's still melting down. It may take a couple more years to finally hit bottom, but if you have a long-term perspective, there's opportunities in commercial real estate right now. Eventually, the reasons people will congregate in cities, in office towers, those reasons are still there. So folks will come back over time, I believe. But in the short run, there's opportunities because a lot of buildings are going back to the bank. Our building has traded hands a couple times before we moved in here. So we'll see what goes on there. A couple other things, Chris, that I had. Theranos, the company that was built on fraud about the finger prick blood test. Elizabeth Holmes is now in jail. The idea, though, of doing blood tests with just a finger prick instead of like a full, drawing of blood has never really gone away. And there's two companies that are working in that area now, Becton Dickinson and Babson Diagnostics. So they're still trying to come up with a simple way to do a blood test. And that's what they were trying to do with Theranos, but then they got carried away and they started lying about what was going on. And of course, that ended up being a big disaster. Chris, what do you have?
Yeah, so recently this week we had a prisoner swap. I think one of the biggest, I read somewhere, the biggest prisoner swap since the Cold War, with Russia, brought home several Americans, including the Wall Street Journal reporter, Evan Gershkovich, and former Marine Paul Whelan, amongst many others. But to achieve this, we had to give up a lot of major bad people, if you would call them, players, most notably Russian assassin Vadim Krasivkov was one of the major ones.
Right.
And then the last thing I have, I think it's kind of notably here, is Chevron. We've talked a little bit about the flight from California and high tax states. Illinois happens to be one as well, where we've seen Boeing, some major corporations move their headquarters, Citadel. California recently had Chevron announce that they plan to move their global headquarters to Houston from San Ramon, California. So that's just another major corporation there, jobs, obviously taxes. There's a lot of impact, economic impact. And Chevron's been in California for over 140 years. Their CEO came out and just said that, with the state's policies, they're really discouraging investing, hurting consumers, and it's just not a place that they believe is the best for the shareholders and the company's interests. So a big kind of blow to California. And this just comes weeks after Elon Musk said that he was going to move the headquarters for X and SpaceX to Austin. And that's moving out of California to Austin. Most notably, he already made this move with Tesla, moving their headquarters out of California to Austin as well. So he's moving all the companies that he has out of the state of California. So big companies are on the move, and we're certainly seeing them move from high tax states to cheaper states, whether it be Florida, Texas. I mean, those have been some of the big states that have really gained market share.
Yes. As it turns out, people do respond to incentives and tax incentives or disincentives. And so people are moving from those high tax states over to the low tax states, and a little better weather down there too. That doesn't hurt either. So we'll see. And the states all have to compete for people as well. And so the big tax states are losing out to the lower tax states where there's more economic activity. So on the international front, Chris, the Maduro team in Venezuela announced victory on the night of the election before they possibly could have even known what the results were. And all the estimates from the counting is that the opposition party won over 70 to 75% of the votes. So now there's huge protests, and Maduro's jailing people and doing all the things that communist governments do. America's a free country. We have a system that keeps everybody in line. Now there's some forces moving in that direction right now in our country, hopefully not. That we keep things, keep things under control. But that's what happens in societies like Venezuela, where some strongman and a Marxist government starts controlling everything, and they're basically cheating. It looks like Maduro lost the election, and they're not willing to give up power. So they're using the military to keep power, which is terrible. China and the Philippines are now in a big fight in South China Sea over various ports and islands in the South China Sea, which China claims the whole South China Sea is their territory, apparently. So they're blocking ships, they're surrounding ships. The U.S. has promised $500 million of military aid to the Philippine government, who's an ally of ours. But China's been very, very aggressive. They clearly are our adversary. Ironically, Chris, we saved China from Japan. If America hadn't stopped Japan, many of the people in China would be Japanese now. But that's the thanks we get for saving China from the Japanese in World War II. And then 1948, then Mao took over, and then we had the Chinese Communist government, and here we go. And now this president is very, very aggressive. And so they're clearly our biggest adversary. And then you mentioned, Chris, support all that unrest in the Middle East. their unrest in the Middle East, the Iranians and Hamas will retaliate in some way. So we'll see if it turns into a big full-blown, war in the Middle East or not. I mean, hopefully not. But Israel finally did kill some of the Hamas commanders, but they killed them in Iran, which is so crossing lines there as well. So anyway, that's all we had, guys. Everybody from what we see out there area. Let me just mention the Leadership Matrix blog. We have another piece about real estate, commercial real estate. We keep harping on that theme, and that's everybody has an opportunity. So we did a post on that. And then also we did a piece on higher interest rates, what that means for everybody. So they may lower rates, but right now higher interest rates have been here for a while. And it's affecting people's credit card bills. So it's hurting people's ability to pay. Also, there are a lot of banks that will struggle in this environment. Last year, we saw a couple big bank failures. And so that, that kind of has worked its way through the system, but a lot of other banks are struggling now as well. And so we just have to be careful in that and make sure that you don't have more than the maximum insured amount at any one bank. We do have some investing programs that move money around between insured banks, so we can talk to investors about that. So that would be one way to solve that problem, Chris. And then the other idea, investing wise, that we will talk about in general, please talk to your advisor about how it would apply to you, but the diversified alternative program. So if you can get better returns out of alternative investing, 15 to 20% in real estate and other alternative investments, that could be a good way to invest. And those alternatives are not down in the stock market today, where everything is down and things are moving around. Well, those prices don't really change that much. And so alternative investments can, really help people in markets like this because those investments aren't down. So we have a diversified alternative fund. There's 6 different buckets you can invest in. And those buckets basically are all well diversified, 20 to 25 different positions. And so you'll get the diversification that you need, and you can get higher returns from that. There is no liquidity in the short run, however. So that's why you can't put large amounts of your net worth in it. But nonetheless, you could get better returns from that. So if anybody's interested in talking about that, let us know, or let your FourStar advisor know, and we'll be happy to work with you on the diversified alternative funds. Chris, that I think is all we have for today.
Yeah, I think that covers it. Now that we're into August.
We're into August, everybody. A lot of people are going to the beach. Europe shuts down in August. We'll see. We'll see if this is. I remember Bush 41 one time when a war started in August. He said, "What is it about August? There's always kind of pivotal things happen in August." So we'll see. It's a month. The kids go back to school, or the month before, in some cases, when they go back to school. So a lot of changes. The summer's nearing to an end. So what is it about August? We'll see what happens, Chris.
Sounds good.
All right. Thanks, everybody. We'll leave it there. We'll be back again with another great episode over the next couple of weeks. And thanks for being with us today on the Today's Market Explained. Over and out for now. Bye-bye.